fiscal policies simply way out of equilibrium, shall we say. It's not sustainable. So I would start doing something with it right now. And as I say, what I would do is be pushing for a constitutional convention and a change in the Constitution that imposed something like the Swiss debt break into the U.S. Constitution. That would fix the fiscal thing right away. The next thing I would do is get a chairman of the Federal Reserve that was in there paying attention to what was going on with the money supply. Somebody like Paul Volcker, who paid attention to the money supply. It's all about the money supply. The current chairman, Powell, is not even looking at the money supply. They don't even look at it. They've poo-pooed the thing.
Hello and welcome to Speak Up here on the Wealthy On Network. I am your host, Anthony Scaramucci. Today, joining us is Steve Hanke. Steve is a professor of applied economics, and he's the founder and co-director of the Institute of Applied Economics, Global Health, and the Study of Business Enterprise at the Johns Hopkins University. Steve, thank you so much for joining us. I'm going to get right into it with you if you don't mind. I love your bookshelf, by the way. I'm a big book reader, so I'm sure you got some really smart stuff on that bookshelf. What's happening in the economy, sir? Where is inflation? We at Skybridge think the inflation numbers are lower than the Fed is suggesting. Do we have that wrong? Are we in a period of long-term inflation?
No, I think generally, broadly speaking, Anthony, you're correct. And the reason for that is that the money supply, broadly measured by M2, the broadest measure that the Fed has been falling and contracting since July of 2022. And it's actually contracted by almost 4% since July of 2022. That's only occurred 4 times in U.S. history. You have to go way back to 1948, 49 to find the last contraction, and then you go back. You got another one in 37, 38, and then of course the big kahuna 29, 33. That was a Great Depression, and then 1920, 1922. You had another contraction. So they're very, very unusual. We haven't had any in modern times, and they're always followed by economic slowdown and recession. Of course, the Great Depression was 29, 33 contraction. So the economy is going to slow down because money is the fuel that drives the economy, and with long leads and variable leads, after you get these changes in the money supply, then you get changes in asset prices, changes in economic activity, and changes in inflation. So what did we have? On the upside, we had the money supply skyrocketing, and in February of 2021, it was growing at 27% per annum. That's a record. It's never grown that fast. And we got inflation, exactly what we thought. Now it's contracting, and back to your point, the inflation has been kind of plateaued a little bit in here for the 4 months, but it's coming down. It's baked in the cake. John Greenwood and I think by the end of this year, it'll be down to 2.5% to 3%. So that's a kind of a long answer, but you got to get the money supply. It's all about the money supply.
Okay, and I appreciate all that. Having been a long-term monetarist, I understand exactly where you're coming from. I guess the question I have is, if you were the Fed chair, let's say you were the whole board, I empowered you, I made you the Fed czar, you'd be cutting rates, you'd be waiting to cut rates, or you're worried about the economy slipping into a recession, an unnecessary recession, if they don't start to move on the rate table?
I would be reducing rates and stopping quantitative tightening. The main thing is to stop quantitative tightening, stop the shrinkage in the balance sheet, because when your quantitative tightening occurs, what happens is that the Fed is no longer buying bonds and refreshing the bonds that are going off maturing. They're having to sell those bonds and when that happens, the general public pays with a check out of their checking account for the bond, and the reduction in their checking account reduces the money supply. So it's a drag on the money supply. So we don't want that. The money supply should be growing. Hanke's golden growth rate, Anthony, is about 6%. Now that's consistent with hitting an inflation target of 2%. If you want to hit 2, you got to grow the money supply about 5 or 6%. Right now, the money supply is just growing a little over 2%.
So my next question is like sort of related to the same thing. It's the fiscal policy. So you've got the Fed probably doing the right thing. They've taken some money out of the system. They're trying to reduce inflation, but we are spending like drunken sailors. I mean, it's 6.5% to 7% of the GDP of the country in deficit spending at a time when the country's more or less at full employment. The participation rate seems to be pretty good, sir. Is that the right thing to do? Where the CBO is now saying we're going to have a $50 trillion deficit over the next 10 years in terms of the cumulative deficit. Is that the right thing to do for the United States?
No. The right thing to do is get that deficit on a shrinking basis, not an expanding basis, and get our fiscal house in order so it's sustainable. Even the nonpartisan Congressional Budget Office says this can't go on. This is not sustainable. So how do you correct it? There are only 3 ways to do it. One is to reduce government spending. That would be the best thing, by the way, for the economy. To goose the economy, reducing government spending and letting the private sector have more of the change would be the best policy. But you also can shrink a deficit by increasing taxes. Now that slows the economy down. So that's not so great. I'm talking about direct taxes, what you pay on April 15th. You can also have another kind of tax to shrink the burden of the fiscal deficit and the debt to GDP, and that's what's called an inflation tax, and that's bad. So all the 2 taxes are bad, and shrinking the government expenditures are good. So I'm on the shrinking government expenditures or slowing those down to close that deficit. The deficit is definitely bad.
Do we have anybody that is willing to do that, though?
I don't see anyone on the political scene that's willing to do that. And if you look at the history of fiscal control, if you have statutory changes that are put in place, new fiscal rules that try to slow things down, those tend to work for a little while, and then they break them. So the only way you really can do it, I think, is to have a constitutional convention under Article 5 of the Constitution and look specifically at how to change the Constitution that would require something like a Swiss debt brake, like the Swiss do. They changed their Constitution, and now they must balance their budget, and the government expenditures can't grow any more rapidly than the rate of growth in the economy. So that's that. I think that's the only long-term solution, really.
If I talk to business leaders, no one cares. If I talk to the campaigns, I have friends on both campaigns, the Biden campaign and the Trump campaign, don't care. Not going to stop it. Not going to do anything about it. Don't care. So why such apathy? You're concerned about it. I'm concerned about it. If I was in the government, I'd be pulling a 5-alarm fire. I'd be working on a 15-year deficit reduction plan. I'd be telling the American citizens how dangerous this is and how we're going to lose our dollar supremacy. You're now spending more in interest rate payments than we are in national defense, and that's only going to accelerate, sir. So what am I missing? Or is it, because there is also wisdom in crowds. Maybe I'm completely wrong. Listen, I've been humbled by life and markets, Professor, so I'm not here even pretending for a moment that I'm right. I'm just Am I missing something? Is the marketplace right that the indifference is the right approach, or should there be some less indifference?
And you and I are in the same camp, obviously, on this on this score. These kinds of things aren't a problem until they sneak up and bite you in the rear end. It's that
Right.
it's that kind of problem. And as Herb Stein, who was the chairman of the President's Council of Economic Advisors under Nixon, once said, if something can't go on, it will stop. And this can't go on, and it will stop. And what people have to think about are those three options that I just mentioned to you. Are we going to squeeze government spending? Are we going to increase taxes, or direct taxes, or are we going to have more inflation tax? That's the only thing that can happen, and it will happen, by the way, because as Stein says, if something can't go on, it will stop.
Yeah. Well, I mean, that's the thing I'm worried about, sir. I mean, this is I mean, and it ties into my next question, which I want to ask you about the stimulus. When I look back at the stimulus and the amount of money that was over inducted into the economy, did we mishandle that? And so the question is, you had a crisis, and so what ends up happening is we overreact to the crisis, or sometimes we underreact, but mostly overreact when it comes to monetary supply and fiscal policy. And so, are we setting ourselves up for that type of collision again? And so first question, though, is, do you think we put too much money into the economy during COVID?
Well, the way we put it in was the problem, because we had a massive increase in government spending, a massive increase in the deficit, and the bonds that were being issued to finance that deficit were being bought by the Federal Reserve. About 90% of the deficit was being what they call monetized, Anthony, and that's why the money supply shot up. We would not have the inflation we had if that monetization of the fiscal deficit hadn't occurred. If those bonds had just been sold to the general public, we would not have had the kind of inflation that we experienced. So it was the Fed that was kind of basically in bed with the fiscal authorities. And that's where the nub of the problem is. It comes back to what I originally said. Money matters, money dominates. It's all about the money supply.
Okay, so let me set the stage for you. It's 2030. We're spending $2 trillion in interest rate payments, $1.25 trillion in national defense, and we're upside down in our budget deficit by $2.5 trillion, and we're having a dollar crisis. People are shedding dollars internationally because they're worried about this upside down apple cart. What would the United States do in the event of a crisis like that, sir?
With those who occupy Washington, D.C. and got us into the hypothetical crisis that you just put forward, it's very hard to predict what they would do. My guess is they would probably panic and make a move that maybe would make the crisis even worse. So it's this is one thing in the markets. I mean, you're in the market every day, and the thing that amazes me is that the markets aren't pricing any of these kinds of things in at all. You and I are talking about the debt and the deficit, and the CBO says this isn't sustainable. We know the arithmetic just can't keep going like this. The markets just don't have anything priced in for that. The markets are not pricing any of these broad things in. For example, the proxy war the U.S. is engaged in with Russia right now in Ukraine, none of that's priced in. What's going on in the Middle East? None of that's priced in. They're just all these larger things that are kind of off beyond the horizon that bite you when they bite, but before biting, nothing is happening. None of that's priced in. No one's pricing in a bite.
Okay. What would you do, sir? Is there anything actionable, given everything that we're discussing? I always like asking our guests this. Is there something actionable that you would do today that would improve your portfolio?
The actionable in terms of fiscal policies simply way out of equilibrium, shall we say. It's not sustainable. So I would start doing something with it right now. And as I say, what I would do is be pushing for a constitutional convention and a change in the Constitution that imposed something like the Swiss debt break into the U.S. Constitution. That would fix the fiscal thing right away. The next thing I would do is get a chairman of the Federal Reserve that was in there paying attention to what was going on with the money supply. Somebody like Paul Volcker, who paid attention to the money supply. It's all about the money supply. The current chairman, Powell, is not even looking at the money supply. They don't even look at it. They've poo-pooed the thing. They said it doesn't matter. It doesn't count. So it's not in their models. It's not in any of their templates. They hardly even report on it. How many times do you see in the newspaper a headline of what just happened to the change in the money supply during the last month? You've got to look in some footnote, even in the Wall Street Journal, to find the number.
What about for my portfolio? What would I do for my portfolio actionable right now, Steve?
Let's talk about the stock market for just a second to get my kind of perspective. The stock market, the S&P 500, it's up about 15% this year, and we've had over 30 record closes this year. And there's very little volatility in the market. This day is the trading range plus 1%, minus 1%. The fear gauge, the Choi index, is below 12. That's the lowest it's been in 5 years. Now that's the price for options to hedge against a downturn in the stock market. The breadth of the market is actually very narrow. 10 stocks make up 37% of the market cap. And if you take those, if you just don't weight, given market cap size of the stocks traded on the S&P 500, just a simple sum of those, the market actually would be down. The S&P 500 be down the last 30 days. So, and the volume's low. And as I say, no factoring in of any of these geopolitical things, no factoring in of what I think we will see a continued slowdown and a recession starting probably late this year, early next year, due to the fact that we've had this monetary contraction. We've got an inverted yield curve. We've got gross output. That's if you take all the sales, we've got gross output is all the sales between all intermediate, everything in the supply chain. And that is growing actually less than, at a slower rate than GDP, which is the measure for final goods and services in the economy. Now that's all of these things are very negative. The market's very pricey. If you look at Robert Shiller's inflation adjusted PE and look at the data since 1881, we have 95% of the time the PE, that inflation adjusted Shiller PE, has been less than the PE is right now. So the PE is, prices are strong. So what would I do? Well, I'm a Buffett kind of guy, and Buffett's rule, when Buffett really piled into Apple, he said, I want to look for a stock that's trading that's cheap, less than 15 as a PE. Well, the current PE is about a little north of 20, 21 in the stock market. So the market wouldn't qualify for the Buffett rule. Then Buffett said, I want a company that there's a 90% chance that the earnings will grow over the next 5 years. And the third element of Buffett's rule, he says, I want a 50% chance that the earnings would grow at least 7% year over year. Well, now how many companies qualify for the Buffett rule investment, plus this overall picture I have of caution in there? The market's pretty toppy. So I would say hang on to your good stocks that are doing well. but pay attention to things, and you're not going to find any stocks to buy that merit buying given the Buffett rule. There's essentially nothing to buy, and then also in your portfolio, since inflation's coming down, you want to be long the 10-year. The 10-year bond. Remember the interest rate on the 10-year. When I was recommending going long the 10-year, the yield was about 5%, and I said, inflation's going to be coming down because the money supply is contracting, and with that, interest rates always follow inflation, Anthony. So if inflation's coming down, interest rates are going to be coming down on these long bonds. So enter the 10-year. I think it's a pretty safe bet. Keep your good stocks that are doing well, and follow the Buffett rule about adding any new ones. And I don't think you're going to find many.
So he just added Occidental. What do you think of that?
He usually knows what he's doing. That's what I think of that.
Right. So, but I mean, maybe the strategy is just to buy Berkshire Hathaway, right? I mean, I often think about that. When I first met him, if I didn't buy any private equity, Professor, if I didn't buy I've just bought him, I would have been fine.
He's over 90 and he's clearly still hitting the long ball.
Yeah, there's no question. All right, so
by the way, he did just buy Occidental, but he also has been accumulating a huge pile of cash.
Yes, I mean, and he mentioned that during his annual meeting in May that he's got this ton of cash that he's built up. I guess people, a lot of disinformation out there. Clear some things up for all of us. The Petro-Dollar agreement with the Saudis, it looks like that they haven't re-upped that agreement. Some people say that that's a big deal. Other people say it's not that big of a deal. But the BRIC countries, many of these countries are thinking about figuring out ways to trade in commodities away from the U.S. dollar. Our sanctions on our enemies have certainly created incentives for these people to do that. Are we at risk of losing our mantle of monetary leadership?
Well, for one thing, that Petro-Dollar agreement, from what I can figure out, never existed. So this has been something that's been floating around on the social media. But as someone who's been studying currencies more or less for over 50 years, I'm not aware of that agreement. From what I can figure out, it never really existed. But be that as it may, what are the risks? Well, the risk, if you go back 2,500 years and look at all the currencies, the world economy for 2,500 years, there's always one dominant international currency. The U.S. dollar happens to be the dominant international currency. There have only been 14, Anthony, in 2,500 years. So it's hard to knock the king off his throne. But how do you do that? When do challengers come in and knock a king off the throne? They come in with basically bad monetary management and bad economic policies of one sort or another. So let's look at the U.S. and the U.S. dollar. Right now, of course, it's unbelievably strong. It's been unbelievably strong for a couple of years. It's the old line as a trader. You'll know this and appreciate it. Buy dollars, wear diamonds. And so that's where we're at right now. So, but if you look at the social media, you've got basically the enemies of the United States who want to de-dollarize. So they're fanning the flames, saying all these weaponization of the dollar, sanctions, and so forth are going to cause the dollar to tank, and somebody else will take over. Well, I agree. Sanctions are a bad thing, and weaponization of the dollar is something that makes it more vulnerable, but something to keep your eye on. But at this point, we're certainly not in any tipping point zone. So you have, China and Russia, they talk a lot about de-dollarization and the fact that the dollar is history. And of course, all the crypto crowds, they put out basically the same propaganda. So you get a lot of chatter about de-dollarization. But the fact is, if you look even for central bank reserve buying, central banks are piling into the dollar now. They're actually increasing their dollar reserves. The percentage of their total portfolios that has been in dollars, it has gone down a little bit in the last 10 years. But one of the main reasons for that is that the Swiss were intervening tremendously to try to hold down the value of the Swiss franc, which kept ever appreciating. And they were doing that by doing what? They were buying euros. They were selling Swissy and buying euros. So that's probably the main factor. If you look in the aggregate reserves of all the central banks, that's the reason the dollar's role looks like it was sliding a little bit. It was mainly that Swiss intervention. Now they're actually coming back into the market and buying dollars.
I mean, it's brilliant exposition, which is why I'm not interrupting you. I want to talk about this tweet that you put out last week. Okay, even though sanctions have a history of failure, U.S. Treasuries announced more of them on the Iranian-backed Houthis in Yemen. The stupidity is doing the same thing over and over again and expecting a different result. So when we agree, I mean, I loved your tweet. I guess the question is, if you were the Secretary of the Treasury, what would you do, if anything? Would you have no sanctions on any of our adversaries, or what would you do?
As a principle, I would deep six the sanctions. They're counterproductive. They hurt the United States more than they hurt the enemy. What do? They strengthen the enemy. You get a rally around the flag effect.
Right.
If you sanction somebody in a country or a country, everybody says, oh, those who are imposing sanctions on us, they're at war with us. They're our enemy. So they want to circle the wagons, rally around the flag. And that's why the history of sanctions since World War I have been a complete failure. There are almost no sanctions have ever accomplished their stated objectives. And by the way, I was involved in this once with President Trump's administration was considering putting financial sanctions on Hong Kong, as you remember. And
yes.
Secretary Pompeo called me one Sunday afternoon and says, we're going to meet on Monday and decide on these financial sanctions against Hong Kong. And I was requested to get your opinion on it. So we talked for about 35 minutes. I was, of course, adamantly opposed. Pompeo was adamantly for. And ultimately, the next day, I got a message back from the White House that just basically said, Hanke, you won. There won't be any sanctions on Hong Kong.
Yeah, well, it was a great move. And thank God for your contribution, because sometimes these things are reactionary and they don't really factor in all of the long-term consequences. So I before we go to the audience,
by the way, the Hong Kong thing is interesting in the sense that the Hong Kong dollar is issued by the Hong Kong Monetary Authority, which is a currency board, and it trades on a fixed exchange rate of 7.8 Hong Kong for $1 US, and it's backed 100% with US dollar reserves. So the Hong Kong dollar is in effect a clone of the US dollar. So if you put sanctions on Hong Kong, what would be financial sanctions? You'd basically be attacking the US dollar. So it would have been stupidity, doing the same thing over and over again, expecting different results. It would have been a complete disaster.
Well said, sir. All right, let's go to some outside audience questions. With an election year and government debt refinancing coming due, can more liquidity keep on powering the stock market in 2024 and beyond? This is from Jay from New York City.
Actually, the stock market right now is not actually being there really isn't excess liquidity. So it isn't kind of a liquidity boom. I think it's basically a high tech boom with this AI fad. If you look at the multiples on the stock market in general, it's about 21, and the high tech stuff's about 30 or north of 30.
Right.
So it's all concentrated. That's what's going on. That's
Right.
it's not a broad based thing due to a huge amount of liquidity hanging around.
Right. It's interesting. The earnings are not bad on certain companies, though, right? I mean, these certain tech companies have done very well. If you take out that Magnificent Seven, though, I get your point that the overall market is not doing as well. I guess.
Yeah, here, Anthony. Here's the thing. If we look forward, and this is the thing, we kind of were talking about this in various ways, and that is, we've got this kind of optimism and kind of sleepwalking maybe into disaster. Now, when you talk about earnings, all the earnings forecasts are going up, but what happens if the economy is going into recession? Earnings go down; they don't go up. But almost no one thinks there's going to be a recession. I do, and I do because the money supply has contracted since July of 2022. That's only happened 4 times in our history, and every time it happened, we had a recession. So I think the earnings forecasts are wildly optimistic. Point number one, and I also think the multiples are high on the high end. So if you don't slap a multiple of 21 on earnings that are forecast to be too high, and put a multiple that's lower, what do you get? You got lower earnings and a lower multiple, and you got lower stock prices.
Yeah, no, it's fascinating because it's crystal clear what your analysis is. I guess the secondary question, though, is if they start cutting rates, let's say they cut 3 times, over the next year, or 4 times, will that, reduction in rates, which eases financing, will that help the market?
You've got 2 things going on with the Fed policy. You've got what's going on with the federal funds, and if the federal funds come down, that's not going to hurt the market. If anything, it's going to help the market. But opposed to that, and something that is going to continue to drag on the economy, is quantitative tightening, and that if that continues, we'll still have an over-tight monetary policy, because monetary policy, whether it's loose or tight, is not determined by the federal funds rate. Forget that. It's all about what's going on with the money supply. And if quantitative tightening continues, even if they reduce the Fed funds rate, you will have continued slow growth in the money supply, and you'll get certainly no goose out of that. That's for sure. It's dragging now. Remember that the money supply right now is actually growing at currently 0.6% year over year. 0.6% year over year, Anthony. To hit the inflation target at 2%, it should be growing at 6%.
Right.
So that's how
good point.
That's how much of a drag this thing is on the on the economy.
All right, let's go to the next question. I mean, it's a really, really insightful point. Thank you, sir. GM, Ford, and Stellantis should exit the Chinese market as soon as they possibly can, a Bank of America analyst said the other day. And so the question from Michelle from Detroit is, how does Detroit stay competitive?
This is an age-old problem. I remember when I was on Reagan's Council of Economic Advisors in the early 80s, the same question was being asked. And of course, then, remember, it was the Japanese cars.
Yes, exactly.
Remember those voluntary restraints that unfortunately, Reagan was forced to do that by elements in the Republican Party, protectionist elements in the Republican Party. And I was, of course, opposed to that. But it turned out, let me just walk you through that. What happened? The Japanese said, we're not going to send, we agree voluntarily, we're not going to send as many cars to the United States as we have been sending. But what they did, they sent all the high-priced models with big margins, and Toyota and all the Japanese car companies made out like bandits, and nothing happened in Detroit. I mean, Detroit's been in sick bay for, at least 40 or 50 years.
So I guess the question is, they never fully get there anymore, right? There's just too much competition, right? I mean, these cars are okay, but they're not. I mean, some of them are okay, but some of them, I mean, are just subpar compared to the international competition.
Yes, and I'm a unilateral free trader, so I'm all for free trade. That makes life better for everybody. For some people specifically, where the competition is super tough, it's not that good a deal. And so the general population benefits from all the free trade, but there are a few groups who get squeezed, and the few, when they get squeezed, they make a lot of noise in Washington. And even a free trader like Reagan had actually a pretty mixed picture on free trade. He was much better than Trump or Biden. There's no question about that. But still, it wasn't a perfect Reagan-esque kind of picture. It was kind of a mixed bag. There was some good, but some bad. And it was the squeaky wheel who caused the problem.
Yeah,
and
understand.
The squeaky wheel was who? It was Detroit.
Yeah. It makes sense, sir. Let's go to the next question. Bought a starter home a few years back with record housing prices. Would renovating be a better investment than trying to buy bigger in the next couple of years? This is from Dave from Long Island.
Yes, in general, because let's say you're in a good community, and you want to stay in that community, but your house is not quite up to where you want to be. You want to stay in that house and renovate it, because number one, it's going to be hard to find another acceptable house in that community. Number one, and number two, if you get out of your low interest mortgage, you're going to be facing a high interest mortgage if you move. So that's just the financing cost switch is something to consider. But realistically, renovation has lots of it's attractive.
Well said, and I agree. Let's go to the next one. What impact does the SEC news that Ethereum will be considered a security have on the crypto market? So I'll take this one. It's from Jamie from Connecticut. I think that the Ethereum decision by the SEC to approve it is going to take some of the market share away from Bitcoin. And so as you look at a pie chart, if you're going to be a crypto investor, some of that money from a pie chart perspective is going to go into Ethereum. So it marginally helps the overall market, but it may weaken Bitcoin, at least in the short term. All right. Well, that was our last question, sir. Any other final thoughts for us before I?
No,
I mean, honestly, I'm really looking for your health and beauty secrets. Okay, because I did Google you and looked at your Wikipedia page. You're a fellow Capricorn, and I got your age, and you look about 15, 18 years younger than you actually are. So, I mean, I probably should have asked you who your dermatologist is before we ended,
And Anthony, you know how to make a guy feel good. I think the company of Mrs. Hanke and her diet does a pretty good trick.
All right. Well, there you go. Okay. So you got to eat right. I think that's probably the bit. You got to invest right and eat right. Those are probably the two best tips that me and Professor Hanke can give you for this coming weekend. Well, thank you very much for joining us on Speak Up I really do hoping to get a chance to see you soon. I'm a huge fan of your work, of course, and was delighted when you accepted our invitation.
Great to be with you. Thanks for inviting me. Great to meet you.
If you like this video, you'll like this video as well. Check it out.